Hey everybody, Preston Brent here with our Trader User Group Weekly Roundup. This is for the trading week ending September 8th, 2017. Hey, before I get started here, we're getting ready to crank up in about 2 weeks or so a really great Option Academy process. For our current members, it's it'll be very easy for you to get into this. If you are not a member but you're watching these weekly updates, I highly encourage you to come in. You're going to get some emails on this over the next couple of weeks. But what we're going to do is, like I said, starting in 2 or 3 weeks, every Thursday we're going to be holding educational sessions, and they'll be recorded, probably 2-hour sessions, and it'll run through probably January. All total, it's going to be 50-60 hours, maybe even more of education, plus an additional 100 hours that I've done before. We're going to be adding on to this. So it's going to be a really great opportunity for you guys. We're going to cover everything from foundational knowledge. We're going to get into a lot of intermediate topics, and then we're going to cover some advanced topics as well. Now, all of these will be recorded so that you can, if you miss a session, you can come in and watch it any time. Because I'm doing these live, there'll be some great interactivity as well. So these things are going to be kicking off in the next couple of weeks, 3 weeks or so, as we wind down the end of the third quarter and get into Q4. Just be on the lookout for that. It's going to be, like I said, a lot of education in the options world. I appreciate everybody coming out and taking a look at our free weekly roundups. If you've been watching these, you know we're pretty darn close to where the market is. We've been doing very well. I founded this group around the week of when Bear Stearns collapsed in September 2008. And we've been doing great since then. And we've been leveraging all the tools and technology that is coming to the markets to help us continue to refine and adjust our option strategies, particularly for those of you that are in portfolio margin accounts as well. So again, be on the lookout for this email. It's coming out very soon. And I think this is something definitely you do not want to miss as part of your educational knowledge. Now, what I've got on the screen here, excuse me, what I've got on the screen here is a daily chart of the S&P 500 E-mini futures. You see I got a lot of lines on there. I'm going to clean it up for you in just 1 second. But this is a very, very interesting market as we wind down Q3 and go into Q4. Everybody knows that the markets have been very low vol, and we've had great trading opportunities since the U.S. elections in November 2016. And you can see from that date right down here, we've just been on a straight tear to the upside. Now, for our members, we were in the overnight hours here, and we were trading, and right at around, not on the E-minis for the S&P 500, but on the Dow, I was getting everybody long in the overnight hours around 17,500 in the Dow futures. And I could just tell by the way the price action was moving. I said, let's jump long and let's hold on to this bull because it's going to run for a while. It's a lot of pent up demand, a lot of opportunities in the area of reflation, meaning all of this infrastructure spending, all of this repatriation of money, tax cuts. The interest rates are going to go through the roof. The inflation trade was coming back into the forefront. Banks took off, construction companies, metals, everything else just took off. And then you can see that we've been now running into a lot of difficulty here. In fact, starting in 2017, which was right in this area here, and then when Trump was officially put into office, right in this area here, you can see the rate of ascension has slowed down. Now, we've still been going up, And a lot of that is due to record corporate profits. And we had another record profit run for Q2. Now we got Q3 coming up. The bar continues to be raised, but the forward guidance of all companies on average so far have been up, not to the downside. So we've got this global growth story running, and I believe that until that comes undone, or until we've got a lot of other existential risk in the market is just going to want to go higher. Now, I understand there are a lot of people out there, me included, that are very probably more nervous than normal. Not so much because of the global growth story, because of the existential risk that are floating around out there. We got the debt ceiling to debate that got pushed off to December of this year here in the U.S. 2 years ago, it was an issue. Last year, it wasn't. This year, because of the divide in the Republicans and Democrats, it could be again in December. We got the potential tax reductions that the Congress and the Senate are trying to get through. So, and that could be a fight. But probably more than anything, we got the issues in the Korean Peninsula. And it's one of those things where, should it happen, we're going to have another volatility pop like we had in August of 2015, which was the highest volatility pop in a one day the markets have ever seen. And we will do that again in lightning fast speed. So that's got everybody a little bit nervous. But the markets do want to grind higher. So this is kind of where we're sitting right now. The global growth story has kept everything fairly benign. If I take everything off the screen here, let me just clean it up just a little bit. And I'm going to just show you a 2017 view of the markets. This really, on the left-hand side of the screen, this kicks off 2017. And you can see we're sitting at about 2461, right? And we kind of approach the year right in the mid 2200s. So we've had a couple of hundred points that we've moved up. But one of the things I want to show you is the volume over price. And you can see these volume over price areas, which is where the most volume has occurred in the market this year. These tend to serve as either support or resistance for the market as the market is moving. So right now, we are stuck in this area right here. It is going to act as our R1, or our primary level of resistance, right? You can see the all-time highs right there. And then we got a lot of support right here, which would be our S1, okay, on a weekly chart, daily, weekly, taking us right down to about the 2420 area. All right. And then you can see there's another, and these are just buyers versus sellers, and you can see who's winning the battle, right? And then down below, we have a wider S2 zone in this area here. So this is what I'm going to be watching as we go into Q4. If we do not have any issues in North Korea, and that stays benign, just a lot of verbal threats, which the markets are now starting to take that a little bit better, then I believe we're going to maintain these levels, probably even grind a little bit higher, provided the global growth story remains intact. And I'm going to show you a couple of charts here that shows it's just going very strong right now, especially in the industrial metals area. So you can see this is what I'm looking at. Now, the other thing I wanted to show you here is you can see these key fib nodes. These key fib nodes are around our volume over price. And you can see this 200% node here at 2465. And that is sitting right at a key resistance point for us. And then down below, we got a 1.618 extension, 2338. So we've got this very wide range that I'm watching. Now, one thing I wanted to point out, we have not had a 3% pullback this entire year. We're going on a record here. We're in the top 3 as far as going for a period of time without a 3% pullback. And what would that look like? Well, a 3% pullback, if I take it off the all-time highs of 2488.50 roughly, and then let's just take it down about 3%. I'll try and get as close as I can right here. All right, so right about in this area right here, roughly around the 2400. So what you're seeing here is, and this to me is a very logical area of support right there. That would give us our 3% pullback. And I will not be surprised at all if we come down and we test this area. And you can see it provided a lot of support here, and then of course resistance here. Now, what we could have is some of you sharp um, um, technical traders may have picked this up. We've got a potential left shoulder here, a head right here, and we're on the right hand half side of forming a right shoulder. Now, we haven't completed the pattern yet, but should we come out here and get us our 3% and then find this would be the neckline. Then we would be setting ourselves up for a further push down into this area right here. Because should we break this neckline, then the range of movement would be about another 75 points, okay? And if you take 75 points away from this, that takes us down from the 2400 to the 2325 area, roughly down in this area right here, give or take about 10 points, because we're not starting it exactly at 2400. We would start at around 2420. And miraculously, it takes us right down to that fib node right there. Because you measure, the measuring objective roughly is the height of the head to the neckline, all right? So the symmetry of all of this is very interesting to me. And I can see this, doing this quite easily. Now, we've got a lot of buying versus selling here, and in this case right here, all the buyers want out. So then the question would be, would the buyers be willing to step in? Should that do that? I have no idea. It depends on where the market is at this time, but I will tell you that if the global story remains intact, even with this pullback, there'll be a lot of buyers stepping in right down here. So this is what I'm looking at in the market on a daily chart, okay? Now, intraday, we can get a lot of the chop up and down, but this is what I'm watching for, this potential head and shoulders pattern setup, okay? Now, that doesn't mean that's what's going to happen, but this is something that I'm watching. Now, if we come in here, okay, and we move down, and then we come up and we take that high out, and we come up and we actually take that high out, that negates that, the head and shoulders pattern that I talked about, and then boom, we're off to the races again, okay? But we're nowhere near that. So this was one of the things that I wanted to show you guys. Now, when I put all of these on the screen here, you can see there's a whole host of other support areas based on different time frames that we're trading. Most of you know that a great swing trade time frame is the 2-hour chart. And you can see here that, since we made the highs here back at the beginning of September, we've just worked our way slowly down. A little bit of a scare the children moment on the coming out of the Labor Day weekend. That was the Korean missile launch over Japan, and then boom, we quickly regained that. But we will take that out if they launch again this weekend. In fact, going into this weekend, I was having our members pick up some extra hedge, because you just don't know what those knuckleheads over in North Korea are going to do. But this is kind of where we're looking at the markets right now, guys. A couple of things that I wanted to show you that shows you the global growth story is just firing off on all cylinders. Let me show you, and this is kind of like, it's called Dr. Copper, which is the copper, it's the commodity for metals. And copper, when it is very strong, that means things are going good in the Asian area, because China is one of the biggest buyers. Now, you can see copper has just been on a tear since the middle of the summer. Now, I'm telling our members, do not chase it up here. In fact, probably taking shorts up here is a higher probability move in the copper market. But you could see this big move higher. Now, the only thing that can move copper like this is China. They're the biggest buyer of copper, which goes into a lot of building materials and supplies. And also the Trump election last year kind of moved copper up until it saw that Trump was going to have trouble getting some of his infrastructure policies in place. But you can see this is primarily because of the Asia Pacific area. Copper's been on the tear. Now, if you can't trade copper futures, obviously one of the ones you could trade is the ETF JJC. It's a Bloomberg Copper Index, and this thing is again on a tear to the upside. We got a little bit of divergence here, which says we'll probably settle in a little bit, and then if this growth story continues, we'll probably have a final push to the upside. Now, and how do I know this is part of the Chinese story or the China story? Well, a good index to follow, if you're looking at China, is Asher, ASHR. Apple Sierra Hotel Romeo. Look at this. This tracks the Chinese index. And you can trade this as well. And we are on a huge tear to the upside. In fact, we hit highs on September the 7th, Thursday of this week. And you can see this huge push higher. This tells us that China they're managing their economy. Now, one thing to keep in mind about China, they manipulate their economy almost as much as a lot of corporations do by buying stock, taking float off the markets, increasing earnings per share, moving money offshore. China is kind of like that, only they're a country, and they're dealing in trillions of dollars. They don't have a Congress and a Senate to worry about. But what is really got this push going here with China is President Xi. They've got what they call their People's Congress. I don't know why they call it the People's Congress, because there's nothing about people there. It's not for the commoner in China. It's like the People's Bank of China. I don't know why socialist and communist countries call their institutions the people's this and the people's that. I guess it sounds good. Makes the peasants feel happy. Kind of like giving you a corner office, just a great office, but you got crap for pay. But that's what China's doing. They're manipulating the market as we go into the end of Q4 because they've got their People's Congress, and Xi wants to maintain the reins of power for another 4 years. He's got a whole lot of things going on. So they're manipulating their market. It doesn't really matter at the end of the day. We trade what's on the screen, and that is really good for China, which is really good for copper and industrial metals. And you can see China going like this. But it's also good because the global growth story is very strong. And an index that is kind of like an all-world index, Vanguard's Victor Echo Uniform. Look at this. Again, 2017 highs on Friday. Now we've got this divergence setting up here that suggests it will pull back. You can see this red line, which is the 50 EMA. But the all-world index is also very strong. I mean, you can see the 2017 open price way down here, and we're way up here. So, folks, we've got a global growth story going on around us. You know, we've got these shakeouts on the Korean Peninsula and all these other things, but we've got a lot of strength underlying the market, and no more so than over in Europe, right? As evidenced by the euro. We'll look at the currencies in a minute. But this is kind of what I'm seeing here across the screen. So that's why when we come back and we look at the S&P 500 E-mini futures, you can see here just the strength in this market, you know, and just where we're going here. So, but I do see that, again, we haven't had a 3% pullback. If we do get it, it'll complete the right shoulder of a head and shoulders pattern. And then we got to watch it very carefully because it could take us back down to the 2340 area very quickly should it break. That would be the measuring objective of the pattern. And everything is kind of setting themselves up for a little bit of a shakeout before we move higher again. And then after we move higher again, then I do believe we're going to give it up in 2018. I mean, I've been calling for the past 8 months, we're going to get us into a bear market. And I think it's going to be precipitated either by China, because they've got a huge amount of debt over there, and they're just jacking up their economy, much like the U.S. jacked up our real estate market in 2005, 6, and 7. That's what's going on in China now. Human nature repeats itself as it always does, and that is reflected in the chart patterns that you see here. So that's kind of what I'm looking at on the E-minis. Of course, if we come over and we watch the Russell, we want to pay very close attention to that. If we go into the Russell futures, and let me just get that on the screen here, you'll see here for the year, we actually went into the red. This blue line is the open price for the rut for the year. And you could see here, we actually went into the red and then we came back out of it again. And if I show you the annual volume here, there is just a mass of volume. You can see this volume over price, and the peak is right in this area here, which happens to be where we opened for the year, right? As far as buyers versus sellers. We need to watch this very closely, because if we take it out, it'll be a fast, quick run to the 2017 lows. We did regain our 50 EMA. Remember, the red is small and mid cap, which shows when there's risk on and risk off in the market. I'm not entirely convinced yet. I'm watching this pattern like this to see, do we get up in this area, then we fail and we come back down and test the lows and do one of these kind of things. Don't have enough information yet on this to see, but that is the pattern that's starting to set up. But one bit of respite here that is good, that you also want to take a look at, this Dow Jones Transports. You can see here we tested very nicely our 200 EMA. We were in the red here as well. We moved back up over the 50 EMA, which is the red line. You can see that's, we're moved there. We test the 200 right there. And now we're sitting at this level. I want to see us take that pivot high out. If we don't take the pivot high out, we've got a high here, a high here. If we don't take it out, we just test it and then roll back over. I think the odds favors coming down and testing this area again, and that breaks, we're down here. All right, and that would then start to complete the head and shoulders pattern on the E-mini futures, and then that's when it can get a little bit dicey going into the end of the year. Okay, so remember, we're in the month of September. September tends to be a more volatile month before we move into October, November, December, which historically have been more kind to the markets. But that's kind of where we're sitting right now, guys. If we come in, and I want to just show you volatility, we're up just a little bit, but we're still in the green zone. We're underneath 15. You can see we're actually sitting just slightly above the 200-day moving average, but that is still extremely low. And we're susceptible to pops to the upside here, as you can see. And this just says right now, vol is still very much on my mind as we go through the month of September. So we got to watch it very closely. And by the way, November and December volatility futures are maintaining rather high levels. They haven't backed off as much as I would like to see. So that does tend to suggest that the markets also have that fear into the vol futures going out in time. All right. And if you can see here, all these colors on the screen, I've got various zones. If we come over here and we look at the weekly chart, you can see I've got these zones which really detail different option strategies that we want to be implementing here, whether in the green all the way up into a black swan, which is the VIX is over 50. You can see this big move here. That was one of the largest increases. No, it wasn't one up. It was the largest on a percentage basis pop in volatility in at least the history of the records of keeping volatility in the markets. And the VIX went from, actually within a week and a half, actually 3 or 4 days, it went from the middle 11s, under 12, up to 53.29. Very, very ugly pop. And if you've got cash on the sidelines, I can promise you, if you're an options trader and it gets up here, that is a good thing. All right. Again, for our Options Academy stuff that I'm going to be, the video academy that we're going to be kicking off, and our video lounge that I'm going to be filling up with all this stuff, I highly encourage you to jump in on this, because it's something that I think is going to be well worthwhile for you. So anyway, that's where we are with volatility. Now let's go look at currencies. Let's look at the dollar first. The dollar is ugly, ugly, ugly. This is a weekly chart. You can see that channel. This starts right at January the 1st. That peak right there is January the 2nd. Actually, January the 3rd, the first trading day of 2017. And then look at what's happened. Okay. It has gone crazy to the downside. When Trump was elected in that area there, the initial urge was inflation is going to go up. The dollar made that move, and then it would look like none of this stuff is going to happen. The dollar just did one of these things right like that. even out accelerated that downward vector, where the vector has been, it started like that, then like that, and now like that. Now that means we're getting near a bottom before we have a pretty wicked counter trend move. There are a lot of shorts in this trade right now. The boat is really loaded to one side. So you've got to be careful, because the counter trend move, when those shorts, when their buy stops are triggered, it is going to go like crazy to the upside. Day trading, I'd be long that thing just to ride it up for a little bit. But I think it's going to run into a lot of resistance up in this level here, and then have a tendency to roll over until we start to find our bottom. Understand, Super Mario Draghi does not want this. Neither does Yellen. What Draghi is worried about is the opposite side of this. If you were to hold this up to the mirror, what you would get is this right here, which is the euro on a weekly chart. You can see we made highs this past week, 2017 highs in the euro. And I mean, this is we hit that mythical 1.20, and look at this. We came right down, missed it by just a few pennies, my projected low for 2017, which is about 1.02. We came down and hit, I think, what did we hit? We hit 103. So we came very close to my low, and then boom, we just came up and took it out, the highs. And I believe we're going to have a counter trend move in the dollar, which means a counter trend move in the euro, which means we're probably, because the central banks, which I call the masters, the true masters of the universe, they're going to probably move this back down in this area here before we have another run higher. Okay. I just don't think Mario wants that strong of a euro at this time. He's trying to talk it down, but the markets aren't hearing anything of it. It's kind of like the bond vigilantes in the 80s and 90s, only in this case it's the currency vigilantes. You can see some divergences setting up here, so I do believe we'll get a little bit of a pullback. Now, the other one that I've been pounding the desk on that I think is more bullish than bearish, is very choppy, is the British pound. I said when we were down in this area here, it's going to be choppy, but if you can hold your breath and hang on, this thing is going to run higher. Now, if you can't trade the futures market, then trading FXB, Foxtrot X-Ray Bravo, which is the British pound from an ETF perspective, I mean, we were down in the 118 area. Now we're up around 128. I do believe this can run higher, but not without some pullbacks, right? You can see we've had these patterns here in the British pound. We just seem to have these almost like these cup and saucer patterns, and then we're just doing these dips, right? And once you get to the bottom of these dips, and you get the trigger, I mean, these things are just, they're really good trades. And you can see here, now I'm not drawing it very straight, but you guys get the idea, right? When we bottom on this upsloping trend line, and this is an FXB, but you could also trade the currency futures as well. But this is a trade that I think is going to continue to do this for a bit. Now, it's really going to take up to the upside once Great Britain works out their trade policies, their new trade policies, once they split up. It's going to be ugly for the next couple of years, but I do believe, as you can see here, money is slowly working its way back in. And if we come over to a weekly chart, you can see just how bad the British pound was hurt. So we're just now getting going here. And again, this is going to take a little bit of time to play out, but we're going to have one of these kind of long rounded bottoms like that, working our way back up into this area. And it could take 2 or 3 years to get up there. But I think longer term, you know, as we do these things, right, it's going to look like this. And we're just going to kind of work our way back up in these dips or these headline news where it looks like Britain is going to come apart. But buyers are just picking these things up. Right? I mean, that's what's happening. So, I've been talking about this for a while. Now, when the Brexit vote happened back in July, we were short. We were up at 2 in the morning shorting the British pound. It was a great trade. And it just worked its way all the way back down here. But now it's working its way back up. And I do believe, again, it's going to be choppy, but it's certainly worth being part of your trading repertoire. If we look at gold, gold is having a good time also. There's a lot of fear going into this gold trade. We've broken to the upside. You can see gold, it broke the 1300 level, and if for our members, what I was talking about was in this area there. As soon as we break out there, the odds favor a break to the upside. If it does break, you'll probably get a retest. This is a daily chart we did 4 days later. I said you can play the break right away or wait for a retest and then play the retest. So a valid entry point would have been right in that area there. Right, it worked out to right around 1304, okay, on the futures market. And then but I do believe we're going to run into some major resistance up here. If I step this out a good bit, let's go to the weekly chart and I'll show you. If we break this thing out, there is gold. There is a huge resistance zone. Now it's very wide. It runs from about 1350 up to about 1450. You can see here that the risk of gold right now, I still think we got some more upside. Not without some pullback into the original upsloping channel here, kind of resting here before another run up like that. Okay, because this is the upward vector of this move. And generally towards the end of a move, the vector starts to increase like this as far as the ascent. And then you have the flush out, the profits, and then another resumption of the upward vector. All right, I don't see any divergences on here that would indicate that it would reverse course. Downside risk is if Yellen comes out more hawkish and we start to see inflation, you'll see gold give up most of this gain and come back down to the 1300 level, which is that resistance bar right there. And it'll give you another chance to go long again. But we're seeing some of this as a fear trade right now. But that's what I'm looking at for the gold market. If you missed that breakout, then don't jump into gold right now. There's a lot of people on this boat. And I do believe that we're susceptible to some downward moves here and let it consolidate before it moves back up again. If you jumped in and took the trade, as I was suggesting, then start to pair some of your profits and then just set yourself up or hedge yourself for a little bit of a downside counter move right now. But that's what I'm looking at with gold. I showed you copper with China. This is copper. I wouldn't chase this either. Let it pull back a little bit. No divergences here to speak of, so I like that. Now, another one which is really interesting is oil. We're 15 trades in a row on our oil trade, and you can see here this oil, once it was defined, this downsloping trend line, we can't get it. And you can see right here what's starting to play out in this area right here is looking like that right there. As soon as we get near or at this level, we start to come back, and you can see on Friday we came all the way back down to that level again. Okay, it's just having a hell of a time. Now the hurricanes are playing a part in it. As I was telling our members, it did just the opposite of what a lot of people thought it would do. If I take it down to the 2-hour chart, you can see this downsloping channel. Right? You can see where price action is trying to break out above it, and it just cannot do it. This is a 2-hour chart, and this is like over a 1-week period, right? Each of these dashed lines here represents 1 day in time. And you can see we got up above again. I said, look for a retest. We retested again, and now we're back below again, okay? And there are no divergences to speak of that would suggest it's going to move higher. So this is what I'm looking at for oil. Now, another interesting thing here is this, and these are great plays. Let me come over here and show you volume, and let me just open this up just a little bit here to show you a little bit of a trick here. And this is just, now I cover this with our members, but you want to basically just take a look at this for a second, okay? And you'll see what I'm doing here. I'm identifying roughly the areas where you have these contract changes in the oil futures. And if you look at these, and I'm going to just go back a little bit like this, right? And when you look at it, these represent a little bit, in that area there, and all these others, these contract changes. And these contract changes also signify potential trend changes right here, right? You can see these trend changes um, in these areas right here, and it's around the third week of the month. All right. Now we've been playing these very nicely, and we've done very well. Now I'm not going to go into any more detail on this. For our members, I will, but we're 15 trades in a row on these trades, and they're working out very nicely. And now we're setting up again for another one over here on the right hand side. Now we take these trades until the market environment changes. The other trade that I was suggesting our members get into was what we call the crack spread, or the reverse crack spread in this case. What is it? Well, the crack spread is where you're playing the difference between oil and gasoline. It actually sounds ominous, but it's actually it could be, I don't want to use the word safe, but it's a hedge trade because you're going long one product and short the other. Look at gasoline futures. Gasoline futures with Hurricane Harvey did this. I mean, it just went right through the roof. And this set itself up for a great reverse crack spread because it was just a momentary spike, and then boom, we came right back down again. That's a big move in the futures market, and you want to make this play, but you can hedge this play by setting it up as a reverse crack spread. And we're going to be, we could, although we're not going to see as much of it with Florida, there are 3 ports in Florida that'll probably be shut down this weekend. Refineries and ports where oil and so forth comes in. But it won't be as extreme as Texas, where 1/3, excuse me, where 1/3 of the U.S. is governed by oil and refineries, actually. So that was a trade that we played that many of our members took that worked out fairly well, fairly quick. Okay. Now, that's where we're sitting. We've also got the ag markets, we've got the meats, and we've got softs. One of the other ones that's coming up with the hurricane, obviously, is orange juice, right? You can see on this daily chart how orange juice, the minute the track is running up, you can see this thing could get a lot worse. Many of you can't trade OJ unless you're in Interactive Brokers now, unless you're playing the extra fee because it moved over to the ICE exchange. But this is another one that could be an interesting play that we were talking about in our chat room about earlier last week, rather, when the hurricane was starting to come. I've been basically short OJ for quite some time, but we took our profits and then we're on the sidelines right now on this. All right, everybody, that's kind of where we're sitting for the weekend. For all of our members down in the Southeast, I hope you stay safe. You've got out of there. As you guys know, I was opening an office in Florida. I'm now doing this for my Connecticut office, but I will be going back down there in a few weeks. But stay safe, stay dry. And for our members, we will have our session this Sunday night. For non-members, be on the lookout for this email. We're coming out with all of these. It'll be a great process. It'll be a great education for you if you're not doing that. And for a lot of you that have already, looked at and purchased individual educational sessions, this will open it up for everything. And I think it'll be well worth it for you to check this out. All right, everybody, have a great weekend. Folks in the Southeast, Florida, Georgia, South Carolina, stay safe, stay dry, and listen to what they say on TV. Take care, everybody. Ciao.